Hi guys, and welcome to Macro Markets. This is Marcel Pechman, analyst and writer at Cointelegraph. For our first show, I'd like to discuss the DXY index, also known as the Dollar Strength Index. So, first things first. What is the DXY or the Dollar Strength Index? Well, it measures the US dollar against a basket of foreign currencies, including the euro, the Japanese yen, the British pound, the Swiss franc, and so on. So basically, the higher the number goes, the stronger the US dollar is. Meaning, if an American travels abroad, he will get more euros, yens, or another currency when converting. You may think that's evidently positive for the US economy having a strong dollar, but it is not that simple. For instance, let's imagine Google, Microsoft, or Amazon, companies that have revenues abroad of the United States in other currencies. So if you have a strong dollar, when those companies convert the foreign currency to US dollars, they get less US dollars into trade. In exchange, the government has less taxing. There's less income for the US government. So a strong dollar is not necessarily beneficial for the US economy. So let's have a look at the DXY index, the Dollar Strength Index chart, and try to understand its relationship with crypto. Notice that the index rallied throughout 2022, starting from 95, going all the way to 114, the highest level in 20 years. I know, you're accustomed to crypto, but believe me, in foreign currency, especially the major ones, a 20% gain in 6 months is huge. So, what happened here? Well, investors are dumping the UK pounds, the euros, the Japanese yens, and buying US dollars. It doesn't matter the reason for the movement, but usually when the dollar strength index goes up, it means that investors want the country with the less risk. So it's a typical movement preceding recessions. And how do you expect crypto to react on such an environment? Well, you guessed it right, ugly. During the so-called flight to quality movement, risk assets tend to perform very bad. So if we overlay Bitcoin's chart, we're gonna see that Bitcoin, the orange line, moved from $48,000 down to $20,000 by November 2022. This is called inverse correlation, when two assets tend to move exactly opposite directions. So you have the inverse chart of the Bitcoin, the orange, versus the DXY, the blue area. But hang on in there. Let's see what happened over the following weeks. Well, Bitcoin continued to nosedive down to $16,000, and the DXY index also dropped to 106. So that's not what the indicator predicted. Similarly, if we closely watch March of 2022, you can see that the DXY index rallied while Bitcoin remained quiet near $21,000. That's the red square over there on March 2022. So why people keep saying that an increase in the DXY, the dollar index, should pressure cryptocurrencies? Well, it is likely because people expect when you have a flight to quality movement, when investors fear recession, and when once the assets with lesser risk, which is the United States and usually cash or treasury bonds, government bonds, it's a bad environment for risk assets such as cryptocurrency. But that relationship, it's not so direct. What I propose instead, my little secret, is moving away from the DXY index, which is plagued by external factors such as wars, tax measures, change of finance ministers, etc., and focus on the US inflation-protected bonds. So what are the inflation-protected bonds? Well, when you buy a treasury note, a debt from the US government, you usually get paid a fixed rate. So if you bought a 5-year US government bond expecting a 4% payment per year and inflation goes up to 10%, it's your loss. However, on the inflation-protected bond, the government will pay you a rate based on the CPI, the inflation data. In my experience, crypto tends to track this indicator much more closely than the DXY index. So the blue line is the TIP, TIP on TradingView, the inflation protected bonds ETF. Its price declined from 128 in March 2022 to 105 in October. It virtually matches Bitcoin's decline from $48,000 down to $20,000. Make no mistake, that's not a magical intraday tracker, not even a week by week, but when you observe every 2 weeks, every month, the results are striking. So what I want you to learn in today's show is there are many factors that influence foreign exchange rates. So the DXY, the dollar strength index, might decouple from the Bitcoin inverse chart, as we've seen on the previous chart. On the other hand, the TIP, which measures the inflation protected bonds, tells us if investors are fearing that inflation will soar, which is good for scarce assets such as Bitcoin, or if they think that the Federal Reserve is doing a good job and there's no need for an alternate store of value such as cryptocurrencies. We are now going to cover the Grayscale GBTC fund. It's a trust instrument, but it acts like an ETF. It's supposed to give you direct access to Bitcoin using the regular brokers where you buy stocks. So this fund was created in 2013. It was listed on the stock market in 2015, and it basically what the manager does with the money of this shell company is buy Bitcoin. So currently it holds over 630,000 Bitcoins worth over $14 billion. It trades under the ticker GBTC. The problem is there's no guarantee that the price that's going to trade on the stock market matches the Bitcoin price of the contents, the 630,000 Bitcoins. So in a regular ETF, the market makers will tend to arbitrage, to buy and sell the ETFs if the price decouples from the price of the contents of the fund. For instance, if you have a gold ETF, and the price of this ETF is trading at a higher cost than this $1,600, $1,700 of the spot gold, the market makers will sell the stock and buy the gold asset. On the other hand, if the stock is trading below par on the ETF, the market makers can do the opposite. But you can't do that to a trust fund because the owner of the fund, the issuer of the fund, decides when the issuing of new shares is open or not, and there's no redemption. You cannot give the shares back to the issuer and say, okay, I want the gold that's backing those shares back, so I'm giving you the shares, you hand out me the gold. That doesn't work that way for a trust fund, which is the case of the Grayscale GBTC fund. We're looking at the chart from Cointelegraph.com, which measures the premium. So it compares the price that the GBTC stock was trading compared to the value of the 600 or whatever Bitcoins at the time holding under the fund. So it compares the price of the GBTC stock versus the underlying Bitcoin contents. If there's a premium, it means that the stock was trading at a higher price than it should. Usually happens when there's excessive demand, when there's FOMO from retail. And you can see that throughout 2019 and 2020, there was a healthy premium up to 30-40% at times, but it averaged around 20%. Again, what causes that is retail FOMO, or if there's some kind of rule that it's hard for the retail to invest, such as the trust fund, where it can only be sold to institutional clients. The institutional client has to wait for 6 months, and then it can resell to retail clients on the regular brokers. So it was a kind of a hassle to get your hands on those shares. Even for the institutionals, it was not that easy, hence the additional cost. And that was true throughout 2019 and 2020. We had some lows of 7% or 10%, and we had some heights of up to 40% premium which is not usual, but can happen in trust funds. Now, we're gonna fast forward to 2021, and you can see that the premium that was hanging around 20% drops to zero in February and then enters the negative area, meaning those traders were buying the GBTC at a lower cost, a lower price than the Bitcoin that was held in the fund. What caused such distortion? Well, certainly more demand for immediate selling than buying on the GBTC, but more importantly, because the fund carries a 2% administration fee charge every year. Doesn't matter if the price of the GBTC goes up or down, the issuer, the manager, charges 2%. And more importantly, you cannot redeem once you are in the fund. The only way to get out of it is selling to a third party on a stockbroker. And if there's no demand for that, because people started to understand the risks of the trust fund, and at the same time, in February, it was launched a Bitcoin ETF Canada, which is a much better instrument. So the demand for the GBTC trust fund vanished, disappeared, causing the premium to turn into a discount. So it was trading below fair value. But what exactly is the relationship here? Are the traditional markets, the GBTC stock trading, dictating what the general mood for crypto investors is, or is the other way around? Well, the GBTC is a big instrument. Yes, it's huge. It's almost $15 billion. But it's small compared to the overall Bitcoin and crypto market. We're talking about $400 billion for Bitcoin, nearly $1 trillion for the cryptocurrency space as a whole. So I don't think it's right to say that the higher premium or discount for the GBTC would cause markets and investors, crypto investors, to be bullish or bearish. I don't think that's right. So when you hear someone saying, we won't see another bull run above $50,000 or whatever until the GBTC premium goes back to zero or positive, I think that's kind of nonsense, because the issue that caused the discount on the GBTC versus the BTC inside the fund was, we can say, regulatory, because it charged 2%. And you cannot get out of the fund unless you sell to a third party, and there's a better product listed in Canada, the ETF. So it's much more arbitrated. So it trades at a 0% premium almost all the time. Having said that, there's a big question here. If we have an ETF, a real ETF, not a trust fund, traded on the United States, if the SEC finally allows that after rejecting it for over 7 years, I think it could definitely bring in some additional inflow for cryptocurrencies. It could help on a next bull run, but I don't think that right now that's a big concern. That should be a big concern, because there's no indication that the SEC will change its stance. That's it for today's show. I hope you guys enjoyed. See you guys next Friday. Over and out.